and welcome to Trading Kaki's very first video. For these videos, we usually adopt the following format. First, we will cover the macroeconomic news for the week and give our views on it. Then we will go into the sector performance by reviewing the different indices as well as the winning and losing sectors. Following that, we will go into the earnings of key companies and see how the performance have fared, as well as any guidance from management. Finally, we will go into our stock picks, where we usually give about 2 or 3 stock picks with the relevant entry prices and target prices. For subsequent videos, we'll then do a trade review where we'll review the performance of the stock picks that we had picked the prior week. This week, the key macro data released were the FOMC rate decision and non-farm payroll. The Fed increased interest rates by 25 basis points for the second consecutive meeting, and this came as no surprise to the market. Fed Chair Jerome Powell did reinforce that disinflation is much early on in the process and interest rates are not restrictive enough to reach their inflation targets. He expects more rate hikes going forward and no rate cuts. However, we do see a higher likelihood of a halt in rate hikes, and that could come much later on this year. Next, we have non-farm payroll. More than 500,000 jobs were added in January, and this was almost 3 times what was expected by the market. To put this in further context, this was higher than the average monthly gain in 2022. Unemployment rate is currently at 3.4%, and this is the lowest in over 5 decades. So what we can see from here is that this is a very tight and very hot labor market, even with companies preparing for an economic slowdown and with all the news headlines you see of the tech companies laying off workers. We can see this putting more pressure on the Fed to dial down inflation, especially with tight labor markets. It comes with wage inflation. Let's take a look at how the different indices fared. The SPX had a good start this year. From the low to the high year to date, it had rallied more than 10%. As of Friday, it closed above the 5-day EMA, and as mentioned earlier, with the Fed interest rate decision, markets were actually unwavered and continued to rally. Currently, the 4.2 level is the resistance level, and once we break out of it, we could see this reaching the 4.3 level as the next resistance level. This was the same levels in mid-August last year. Comparatively, the Dow Jones Index had a more moderate return of less than 5% from the low to the high year to date. 34.5 remains a strong resistance level. The Nasdaq outperformed the other 2 indices that we just talked about, and this was fueled by expectations that rate hikes will reach a peak this year. Its low to high year to date was close to 20%. The next resistance that we can see it testing would be the 12.7 levels. Similar to the Nasdaq, small and mid-cap stocks rallied year to date. From the low to the high, it gained 15.5%. This upward momentum is still strong, and the next resistance that we'll see it test is the 2030. The VIX, which is the volatility index, continued to trend downwards to the low of 16.3 as we saw in the beginning of last year. The dollar index fell back to April 2022 levels. However, it had rebounded strongly in the last 2 trading days of the prior week as the US labor market remains strong, especially with the non-farm payroll and unemployment data that came out. Looking at the Chinese market, Chinese tech stocks pulled back after the Chinese New Year holiday. The rally before the New Year had already priced in news of the reopening. However, Chinese-US tensions escalated again, as you can probably see in the headlines that there were news of a Chinese surveillance balloon found flying over the US. So this gave investors opportunities to take profit. Let's take a look at the US government bonds. The spread between the US 2-year as well as the US 30-year government bond remains wide. This implies that recession concerns are not over, as the longer-term yields, which will be the 30-year yield in this case, continues to remain compressed. Taking a look at the crypto markets, both Bitcoin and Ethereum had consolidated after bottoming out post the rally that they had since the start of this year. Bitcoin's next resistance level would be the 25,000, and Ethereum's resistance level would be the 1,800 level. The top performing sectors this week were the technology, communication services, and consumer discretionary sectors, while the worst performing sectors this week were healthcare, utilities, and energy. This week, we will cover the earnings of 5 major companies: AMD, Meta, Amazon, Apple, and Alphabet. First to report earnings among those companies is AMD. AMD's revenue and EPS both beat estimates, and they were among the better performing tech stocks this week. Going forward, we see the demand for high-end chips, which would include either AMD's or NVIDIA's GPU, being revived, as ChatGPT, which is a chatbot by OpenAI, will ignite a new wave of AI development. At the same time, we see the bottoming out of cryptocurrencies, as we have pointed out earlier, being a tailwind for the semiconductor industry as well as AMD, as cryptocurrencies would usually require a high amount of computing power. Next, we have Meta. Even though its earnings missed estimates, its revenue beat estimates by a long shot. This was mainly due to the increased number of users across Facebook and its family of other apps. This increase in sales, together with its share buyback plan, is seen as a positive by the market, which sent its shares surging close to 30% following its earnings. Going forward, Reels, which are short curated videos such as your IG Reels, will be the key turnaround catalyst, which will increase user engagement and retention. Other catalysts include its progress on its AI discovery engine. Previously, Meta had also been right-sizing to reduce operating costs, which should improve earnings going forward. Amazon was the worst performing tech stock this week, as its earnings missed estimates by the biggest margin among the other tech stocks. Going forward, the management anticipates an unfavorable impact from foreign exchange rates. Our take is that even with a strong holiday shopping season, where consumer spending should be the most resilient, it is evident that inflation and high interest rates still overhang, which should continue to eat into their subsequent quarters. In addition, its AWS or Amazon Web Solutions segment posted slower growth. Overall, we find that the fundamentals lack any positive catalyst or any real innovation on the ground, and the macroeconomic environment, including supply chain volatilities, has yet to play in its favor. Apple posted a rare double miss on both its revenue and earnings, and this was mostly on the back on poor iPhone sales, particularly its iPhone Pro model, which suffered from supply chain issues. Going forward, we expect consumer electronics spending to hold the base for growth in 2023, and a slower growth for its hardware and service sales. Alphabet, also known as Google, missed estimates on both their revenue and earnings. This was due to a decline in advertisement spending, which comprises the bulk of its revenue. Again, this is evident of inflation and high interest rates eating into not just consumer spending but also corporate budgets. Going forward, we see increased competition from AI platforms such as ChatGPT and other AI startups. These are the upcoming earnings next week to look out for. Key ones to watch for include Disney, Uber, Lyft, and PayPal. We have 2 stock picks for you this coming week, Uber and Airbnb. There are 2 key catalysts for Uber. First would be the expansion to new markets, where they plan to get every taxi on Uber by 2025, with a key focus in Europe. Uber, which is predominantly in the US, plans to increase market share across its overseas markets, particularly Spain, Germany, and South Korea. In addition, there's further runway for growth for its Uber Eats platform. With already more than a quarter market share in the US, it is well positioned to ride on the growth of the food delivery market and the even faster growth of the grocery delivery segment. These are recommended entry and target price for Uber at $32.50 and $37.50. Typically, we set the risk-reward ratio at 2:1. So for here, you can see that the potential profit is 15% with a stop loss price set at 8%. Next, we have Airbnb. The first catalyst will be the return of Chinese international tourism with the reopening of China's borders. As we already know, Chinese tourists are a major source of international tourism in many markets. The second catalyst would be a new apartment rental platform launched in the US, where tenants can also host their homes, or also called subletting their homes. With the high rentals in the US, tenants would seek additional ways to supplement their income. These are recommended entry and target price for Airbnb at 110 and 130. This represents a potential profit of about 18%, and we recommend a stop loss at about 9%. That's all we have for this week. We hope you enjoyed the content. Do remember to like, subscribe, and stay tuned for more updates.